Good morning. This week we're going to focus quite a bit on the latest developments in global markets as a result of the Russian invasion. We'll have a look at the latest COVID cases and a very brief review of the South African budget. We'll start in the usual way by having a look at the latest number of COVID cases. And at least there's a bit of good news here. The number of cases globally is down 15% week on week. It's about the third week in a row we've seen a pretty sizable decline. And the number of deaths is starting to decline as well. So as a result, over the coming weeks, we're going to spend much less time highlighting this data. From our perspective, it's COVID case closed. From an economic perspective, we're going to be shifting our focus elsewhere. We'll flag these numbers probably once a month, or if we start to see another flare-up. But we can, at this point, we think, pencil in other factors affecting economic growth rather than COVID over the coming year. And one of those factors is what's happening with Russia. Over time, the Russian central bank had been building up reserves. They now total over $600 billion, presumably in an attempt to ensure that at some point they could defend the currency. However, the Russian central bank has been sanctioned, in addition to a number of individual banks being removed from SWIFT, excluding energy payments. And the net result of that is that it's not at all clear that the Russian central bank will in fact be able to defend the ruble in the way that they may have hoped. And the net result is, as of this morning, the ruble is down around 28%. That's the largest one-day decline that we've seen in at least 25 years. In addition to that, we've seen some pretty sizable moves in the Russian market over the past couple of days. The chart on the left shows the equity market, which was down 30% on Thursday and then up 19% on Friday. The chart on the right is the long bond yield in Russia, which is up to over 16%. The point out of this is that we are seeing massive increases in volatility, outsized moves for the currency, for the equity market, and for the bond market. And that itself poses risk for the global market. We don't know what banks could potentially be caught out not being able to hedge puts. We don't know what hedge funds may well be exposed. And these will have longer-term consequences, which we will only become aware of over the coming months, and something to be aware of in the back of our mind. In addition, there are other short-term consequences. The oil price is now above $100 per barrel, but here there is spare capacity. The chart on the left shows the total number of land-based rigs in the US, and that has been increasing of late, and there's still some way to go before it gets back to where it was a couple of years ago. So we know that there's extra capacity in the US that can bring on stream. In addition, OPEC has roughly 4.5 million barrels per day that they can bring on stream in less than 30 days, and they can keep it flowing for around 90 days or so. So there's a lot of extra capacity in oil, and in addition, a lot of the sanctions are specifically catered in such a way as to avoid impacting on energy payments. The net result of that is that we may well see a temporary spike in energy prices, but then we'll see extra oil coming on stream as producers are incentivized to increase production. There is, however, a longer-term consequence to higher energy prices, and this chart shows the sensitivity of changes in efficiency gains for vehicles in the US as a function of increases in energy prices. And this goes from 1975 through to now. What we can see is typically for every doubling of energy prices, there's a roughly 20% improvement in vehicle efficiency over the coming 5 years. The point out of this is if there is a disruption to energy supply coming out of Russia, and it particularly affects Europe, what we should pencil in is a marked shift from Europe away from hydrocarbons. There will be improvements in efficiency, there will be a shift towards renewables, maybe even a shift towards nuclear. And the net result is that will probably take some time to pay out, but we will see a shift towards less carbon-intensive means of generating electricity in Europe. It will have longer-term consequences. It will play out over several years. The result in the US is over 5 years, typically in the data that we've got. But we will likely see that shift in Europe. And that's one of the long-term consequences that we'll see of what's currently occurring. It's a slightly different story for wheat. It's much more difficult to bring corn production or wheat production on stream very rapidly. And Russia and Ukraine account for 25% of global exports of wheat and corn. And as a result, we're seeing a pretty sizable increase in grain prices. The Bloomberg grain sub-index is at a 5-year high. This will have consequences for food price inflation down the line, but in addition, margin compression for food producers. Now, there will no doubt be a number of other short-term and long-term consequences of what we're seeing, aside from the humanitarian cost. Russia is critically important for a number of energy commodities, food commodities, and precious metal commodities, and platinum amongst them. And a lot of these will only become apparent over the coming weeks, and it is something that we just need to be aware of in the back of our mind, that we can do all the analysis that we like in the short term, but the reality is we are not sure at all what the consequences are going to be for global markets and global commodity prices in particular over the coming weeks, months, and potentially even years. In that environment, it is still strange that the market is pricing in 6 rate hikes from the Fed over the coming year and is still pricing in a hike in March with 100% certainty. Presumably, one of the longer-term consequences coming out of the recent developments is that we will see more caution from central banks given greater uncertainty. But the market is not subscribing to that belief at all at this point. Lastly, shifting to South Africa, we had the budget last week. The key nub out of the budget was that there was a material increase to revenue expectations. Revenue for last year was raised by about 180 billion rand. Revenue expectations for next year were raised by about 140 billion rand. And of that 140 billion rand, roughly 80 billion rand is being used to reduce new amounts of debt, and roughly 40 billion rand is being used for extending social grants. So there's a clear emphasis from the government in an attempt to reduce the amount of new borrowing that we would be incurring over the coming years, and presumably that is an attempt to reduce borrowing costs for the state. That's very helpful for the bond market, but also allows us to get some insight into what government's priorities currently are at this point. Instead of reducing personal income tax, they decided to reduce the amount that they're going to borrow. Very helpful for the bond market, potentially less helpful for retailers. And that's where we're going to leave it for this week.